For the Comptroller, Scott Stringer.
John Dorsa for Comptroller Scott Stringer.
For the Commissioner of Finance, Jacques Jiha.
Phil Dukes for Commissioner Jacques Jiha.
For the UFA, Mr. Gerard Fitzgerald.
Leroy McGinnis with Gerard Fitzgerald's proxy.
Okay, for the UFA, Mr. Leroy McGinnis.
Present.
For the UFA, Mr. Edward Brown.
Present.
For the UFA, Mr. John Kelly.
Present.
For the UFA, Mr. Peter DeVita.
John Kelly has Peter DeVita's proxy.
Okay, for the UFOA, Mr. Jack Kelty.
Here.
For the UFOA, Mr. John Farina.
Here.
For the UFOA, Mr. Paul Mannix.
Here.
And for the Fire Commissioner, Daniel Nigro.
Carol Brown for Daniel Nigro.
We have a quorum.
Thank you, Pat. Let's move to police next. Kevin?
Representing the PBA,
Joe Alejandro, designee for Patrick Lynch, John Puglisi, and Mubarak Abdul-Jabbar.
Dan Torelli with the proxy for Merritt Riley.
DEA,
Michael Palladino, DEA.
SBA,
Anthony Bradley, designee for Ed Mullins.
LBA,
Lou Turco.
and the CEA. The LBA's got the proxy. Representing the Commission of Finance,
Phil Dukes for Commissioner Jacques Jiha.
representing the Mayor,
John Adler for Mayor Bill de Blasio.
the Comptroller,
John Dorsa, designee for Comptroller Scott Stringer.
and the Police Commissioner.
Stephanie Zimberg, designee for Police Commissioner O'Neill.
We have a quorum.
Thank you, Kevin. Next, let's move to the Teachers Retirement System. Patricia Riley,
John Adler,
present.
Thomas Brown,
Here.
David Kazansky,
Present.
Deborah Penny,
Here.
Raymond Orlando, John Dorser.
Present.
We have a quorum.
Thank you, Patricia. And NICERS, Melanie? John Adler, present.
David Jetter for Controller Scott Stringer.
Larry Shimmy representing Tish James Public Advocate.
Aldrin Bonilla for Borough President Gail Brewer.
Borough President Bronx. Borough President Queens.
Angelina Martinez Rubio for Borough President Melinda Katz.
Borough President Staten Island.
Isaac Gordetsky for Borough President James Otto.
International Brotherhood of Teamsters.
Ruben Torres for Gregory Floyd.
Transport Workers Union.
David Katzman for Tony Otano.
District Council 37.
Raymond Santander for Henry Garrido.
We have a quorum.
Thank you, Melanie. And for BERS, Sandy Rich?
Mr. Adler, good morning.
Good morning.
We do not have a quorum. We will administer this business at our next regular board meeting on April 25th.
Thank you, Sandy. So just to review our agenda for this morning, we have two agenda items for public session, risk update, and asset allocation discussion. We will then entertain motions to enter executive session, and we'll do manager presentations up here. And then lunch will be served up here, and there will be a hedge fund discussion for the two pension funds, fire and police, that invest in hedge funds. We'll see whether we do that upstairs or downstairs, and then we'll have caucuses for each of the systems downstairs on the 8th floor. Okay? So with that, we'll hand it over to BAM, I believe Miles Draycott, to lead us off with the risk discussion.
Hello? Well, I think I may be mic'd up, actually. Yeah. This is a slick operation we have here. All right, so I want to talk to you a few minutes today about two things. I want to give you a quick update on the status of the MSCI implementation, and then I want to go through a set of sample risk reports that the system will be producing, initially just reporting on public markets holdings. So, no clicker. There we go. All right, so with regard to the updating you with the status of the implementation, we've actually produced the first set of risk reports. They detail risk as of the end of February. Actually, reports specific to each of your systems, or at least the highest level. There's sort of a hierarchy of reporting that's possible. So the highest level is the total plan risk, and those have been loaded up into Convene, and they're specific to the system, each of your systems. What we're going to talk about today are a set of sample reports that we've constructed, which are sort of based on actual New York City pension systems holdings. But anyway, back to updating as to the status of the implementation. The first set of reports has been produced. We can produce them. They are being produced on a monthly basis. We intend to distribute them to you at least quarterly. I'm going to get into the production cycle a little bit and explain that. But for public equities, public fixed income, and hedge funds, we are about to start distributing risk reports. The implementation of the reporting on private markets assets is it's a significantly bigger lift. In the case of the public markets, the challenge is just getting data, largely getting data from the custodian to MSCI, along with some index data. In the case of private markets, there's the aggregation of data from really multiple sources. You know, the GP, a vendor that maintains a database of GP holdings. So a lot of information, a lot more information needs to be brought together to produce the private markets risk reporting. But we do expect that that process's implementation is underway. We expect to start producing reports that include the risk of private markets in the third quarter. The final step of the risk system, the risk reporting implementation is ETI. Majority of the ETI assets are actually publicly traded bonds. That's pretty straightforward. But there is a sort of a direct lending aspect of the ETI program. And there's sort of an option-like feature there that we're discussing how to value with MSCI. But that's underway, and we hope to have incorporated the risk of the ETI program, or fully incorporated it, again by the third quarter. Now, once the risk system implementation is completed, we're then going to move on to another implementation, which is nearly as big a lift, which is about P&L, performance attribution. And that's something that we're not even going to start addressing until the third quarter. Okay. So as I said, our goal is to distribute the public markets reporting at least quarterly. In the case of the private markets risk reporting, it's quite likely we will never deliver reports that include risk of the private market investments more often than quarterly. And the reason for that is twofold. First of all, the marks aren't updated by the GPs more often than quarterly. So giving you information inter-quarter is going to have perhaps little value. And then the second thing is we haven't yet got our arms around the amount of error checking that's going to need to be done here at BAM before they're distributed with you. And our thought is the sort of work that's going to need to be done on the private markets is just more involved than public markets. So the next thing I want to go through is give you a sense of what the production cycle consists of. And really I want to draw your attention to a couple different things. We've decided we don't want to distribute risk reports to the trustees unless it's based on audited holdings data. So given the current arrangement with State Street, audited holdings are only produced once a month based on the end of the month. And it takes some time for State Street to do this. It takes about 3 weeks. Okay, so then you layer on top of that, MSCI has to have a couple weeks to process the information, and then BAM at the end needs a couple days. So you're looking at a delay from the end of the month to the dissemination of the risk reports, loading them up into Convene so you all can see them, of something like 5 or 6 weeks. That's given the current arrangement, which is a monthly audited holdings report from State Street. So here I want to, today we're going to talk about public risk reporting at the total plan level. And it's really, it's only exclusively focused on public market securities. So we've got public equities, which so U.S. market equities, developed market, emerging markets equities. We're also looking at public fixed income, which includes all of the publicly traded bond holdings, but it also includes high yield, which are publicly traded, but it also includes bank loans. So it's everything in the fixed income orbit except the OFI holdings. So reporting is also going to be available at the kind of asset class and sub-asset class level. We have generated risk reports, and they're in an appendix. We haven't loaded them onto Convene that detail the equity and fixed income risk that drills down into that. Time permitting, we may get to that, but I want to leave enough time for questions after we go through the total plan reports. The other thing I really want to mention at this point is there's quite a lot of information that we're going to go through relatively quickly. And what we're looking at on the screens is somewhat anonymized. So what I would like to do is really suggest that we're going to be state that we're going to be reaching out to trustees to see if there's appetite for kind of a more detailed teach-in about the reports, and specific to each system. So that's something BAM would love to host, or we can travel, however the logistics need to be arranged. So. Now this, we're not going to spend a lot of time on this page. I just wanted to put this up. It's almost large enough so you can read it. And at this, we're going to drill into some of the information on this page in a second. But I wanted to, this or something like this is in Convene detailing the risk of your system. As I mentioned before, this is not any specific system, but it's based on holdings of the New York City pension systems. And is representative of the portfolios of the system, any one of the systems. But so here we're going to see repeatedly throughout the deck information both laid out in tabular form and in a graphic form. That's going to be consistent through each page of the reporting. The other thing to mention is that this is focused on talking about two different types of risk. The volatility of the returns, that's what's referred to in MSCI parlance as total risk. And it's also going to and we can drill into the components of that, where it comes from. And then it also focuses on detailing the active risk. So active risk, to remind you, that's tracking error. So it's the volatility of the excess return. So it's the reporting is seeking to understand both, or portray both the level of absolute and relative risk in the portfolio. Before we sort of drill into some of the information on this page, I also just want to remind everybody that though these reports I think are very important, it's a function of the risk group to generate this kind of reporting for the trustees, but this is a small portion of the value we expect to get from MSCI. In addition to generating these end-of-month reports, it's going to be a really valuable tool for the asset classes to use in underwriting a manager. Where's both or evaluating an existing manager or a potential manager? Where are the returns coming from? If you layer the manager into the portfolio, does it concentrate or diversify the risk of the portfolio? So it's a powerful tool that should be and will be integrated into the underwriting process. And the other thing to emphasize is though these are the somewhat canned reports that are produced by the application, it's a very powerful analytics tool. So we can run a lot of ad hoc analysis. And you're going to start seeing, I hope, and hearing more from the risk group about that analysis. You've seen a lot of reports of the tracking error that a divestment, either existing or potential divestment. That's all analysis that we've done using MSCI. We're going to start looking with Mike Haddad at the impact of the basket clause. If we weren't constrained by that, what would be the extra return we might have earned? That's something we're going to attempt to quantify using the MSCI application. You're also going to hear from us a little bit today and subsequently over the next couple of months about FX risk. What's the cost of hedging it? What's the benefit? Were we to hedge it, what does that translate into in terms of an increase in the expected return on the portfolio? So that's all analysis that can be done with what we've. Well, I don't know if it's reassuring. So far, what we found to be a very powerful analytics tool that I think is going to be very helpful. Okay, so now drilling into the information on the first page, we have kind of the headline number is the total risk of the portfolio, which is that's the volatility of projected. This is ex ante, so this is the volatility of the expected return on the portfolio. So that's a projected that volatility, that risk number. It's projected by the MSCI model based on recent correlations and asset exposures and volatilities. So that's at 666 basis points. The interesting thing that we can do see in this report is we can compare that to the total risk of the benchmark. And you note that here that we're running slightly less risk than the benchmark. And that's consistent with the further down in the stack of numbers we're trying to draw attention to. We calculated beta. So the beta is, the two volatilities are close. The beta is less than 1. That's consistent with the risk of the portfolio being slightly less than the benchmark. So the other numbers to spend just quickly mention or make sure you're aware of is we do actually also highlight the active risk. We see that that's 94 basis points. Again, that's tracking error. That's consistent with a portfolio that does rely on index strategies for some of its investments. And then finally, I do want to just draw your attention to the fact here that the duration calculation, that's not the duration of our fixed income portfolio. This is a number which is essentially a weighted average of the duration of everything that the system owns. So it includes equities, and in this calculation, they're assumed to have a 0 duration. The actual duration of the fixed income portfolio is closer to 6, but it's only a third of the portfolio. So that number, roughly sinks to what our expectation should be. Is. So here we can try to drill into, what we're going to do is first drill into the active risk, the total risk, and then turn to the active risk. So here we see the first decomposition of the total risk of the portfolio. And when we're looking at the total risk of each of the two primary public asset classes, we've got public equity and public fixed income. And we can see this coincides with our expectation. The equity is contributing most of the risk. We all expected that to be the case, and this verifies it. So of the 666 basis points of total risk, 631 are coming from equity, so about almost 95%. And as you expect, the volatility of the fixed income asset class is much, much lower. It's only 35 basis points, which is a little over 5% of the total risk. So that's about what we would have expected, or that relationship is about what we would have expected. Before I go any further into sort of drilling down into the factor analysis of the risk, I just want to back up for a second and talk very briefly about factors. We're not going to get into how are they calculated, or what the details of how they're calculated, but I just want to, at the highest level, mention what they are. So basically, in a factor risk management framework, the thought is that assets can be considered a bundle of risk factors. And every asset can be kind of decomposed into some combination of those risk factors. And that doesn't sound like much, but that's a fairly powerful insight. Basically, you have this framework that can understand the risk of any asset, from the most generic strategy, such as a U.S. index strategy, equity index strategy, to a long-short hedge fund. And this is, I say this is powerful because what it allows you to do is aggregate risk across everything that the portfolio is invested in, rather than just considering silos. So that's a major benefit of procuring a factor-based risk management system. So I want to drill into the first. I'm going a little bit out of order here, but I want to just mention the risk to one factor that you're going to hear more discussion about from us, and that is the currency factor. So the currency factor arises from our investments in things that are not denominated in dollars. And the reason to briefly draw attention to this is, although a relatively small portion of the portfolio is invested in non-dollar securities, it does contribute a reasonably significant amount of risk. So about 77 basis points of the total of 666, so almost 12%, is coming from the fact that we invest in currency, in securities denominated other than the dollar. So we're going to talk more about whether something should be done about that, what the cost and benefits would be of hedging that risk. The next thing to look at is just drill down into how much of the risk comes from common factors. And factors here are slightly different than asset classes. Asset classes can incorporate multiple factor risks. So there's not, so our equity factor risk is different from the risk of our equity portfolio. And we're going to spend a little more time on that in a second. But here we again see that a lot of the risk comes from the equities that we invest in. So about 83.6% of the common factor risk is coming from the equity factor, and a small portion, 29 basis points, is coming from the fixed income portfolio. So again, that roughly syncs with the high level, assumption we would all make, which is the risk is coming from the equity asset class. I want to turn, so now we start turning to decomposing the active risk of the portfolio. And here we have the relationship between the fixed income assets and the equity assets completely flips. We had most of the risk on the portfolio most of the total risk coming from the equities, equity holdings. When it comes to active risk, the relationship is the reverse. Most of the active risk is coming from the fixed income side of the portfolio. Active fixed income management is much more prevalent in the fixed income asset class than the equity asset class. And we have, in our case, so the equity component of the portfolio is much larger than fixed income, but an awful lot of the equities are, so it's larger, but it's also largely invested in passive strategies. So that would contribute almost no tracking error. About 62, you're probably all aware of it, but about 62% of the system's equity holdings are invested in passive strategies. So that this relationship does kind of make sense. All of the risk is coming from equities, but much of the active risk is coming from fixed income. Now we can also decompose, we also see a decomposition here of risk, both by asset class and by broad factor exposures. And the reason that this is interesting is I mentioned earlier that asset classes decompose into multiple factor exposures. And I also suggested there was a distinction between the risk of the equity asset class and the equity factor risk in the portfolio. And that's important because we see that here. If we look at the If we look at the first line, first row of the table, we see fixed income. And if we look at the factor exposures embedded in the fixed income portfolio, we see it's exposed to both equity factor risk and the fixed income factor risk. And I point that out because so that we see there's a distinction between the factor risk and the asset class, and that the asset class can embed exposures to multiple factors. And the reason, because it's probably a question some of you are curious about, is how do we get equity factor risk in the fixed income portfolio? Well, the answer is the holdings consist of convertible bonds, which have an explicit equity component. There, you have the option of converting the bond into equity. And we also have high yield is included in the fixed income holdings, the asset class. And high yield, some high yield bonds, the riskier high yield bonds can default, become equities, and those clearly create equity factor risk. So what have I done? Oh, sorry, there we go. So just a couple more pages decomposing the active risk. Here we see that active risk can be decomposed into both asset allocation risk, that's allocation risk, and to selection risk. And the point I want to make here is that there's a little bit of a disparity between what you may assume selection risk to be and how it's presented in this report. So allocation risk is the risk that the actual allocation of the portfolio isn't that prescribed by the asset allocation you all approved. So some sort of tilt would be picked up and would be represented here as allocation risk. But the selection risk, so that's probably intuitive to most of you, but the selection risk displayed here there's a little bit of a nuance I want to explain. Selection risk is both the risk created by active managers, the active risk created by active managers buying out of benchmark securities, it's also a risk created, an active risk created by a potential benchmark mismatch. So if you were to aggregate all the manager benchmarks up, how does that compare to the risk of the portfolio, to the benchmark risk? And so you kind of have in selection risk, you have both the risk of the managers making off benchmark bets, and you also have the risk of a benchmark mismatch, of a selection of a benchmark that doesn't roll up to that that would be implied by your, or suggested by your asset allocation. We hope in a future iteration of this report to be able to drill into those two components of selection risk. It is available through the application. It's not something that's portrayed in this report. So rather than going through exhaustively each page of the risk report, probably I've gone through this a little quickly, I just want to mention that there's a number of other sort of sections of the total plan risk report that break out risk by by region, by country, currency, GIC sector, bond rating, bond sector. The only point to make here is currency is not currency risk. It's just an enunciation of the currency in which the various investments are denominated. Now, there's one more, before we open it up to questions or move on to look at one of the asset classes, there's one more page of the total plan risk, which I think is probably of interest. And that's a page which kind of details stress scenarios. Okay, so this is helpful because it's sort of intuitive. What happens if history repeated itself? So we look at the factor returns in some chosen scenario. Okay, it could be the financial crisis, or it could be a period when the market did really well, and we say, okay, suppose those same returns, factor returns, occurred today, and our existing portfolio or the benchmark portfolio were subject to them. So it's an attempt to say, well, if history repeated itself, how much would we make or lose today? And that's all set out here. What you have there is just in the column there, the numbers are just the change in value of the portfolio in percentage terms. So this is helpful, and we can, again, if we want to, any of you that want to spend time with us and suggest other scenarios, they can be very easily incorporated into this report. All right, now I went through that quickly, but I wanted to make sure we had time for questions. If we get through the questions, we can actually go and look at an equity or a fixed income report.
Questions? Questions for Miles? Oh, you stumped me. Okay. Go ahead, Antonio. Antonio Rodriguez.
Thank you. One particular question, you were talking about how much of, kind of our active risk and our selection risk is due to benchmark mismatches, or in particular that the rolled up kind of asset class benchmark is not the same as if we were to weight each of the benchmarks for each that we hold each of our managers to in that asset class. Do you guys see in the future that maybe in the future, our benchmark will be kind of a rolled up benchmark of each of our managers? Like, I'll give an example. We have some S&P 500 or 400 managers, which are in our U.S. equity. Would we think about having a custom benchmark overall at the asset class level, or just?
Well, so again, you're bringing up the fact there's the policy benchmark, and then there's a potential mismatch between if we roll up all the manager benchmarks. And I don't know that should be a forced identity. I think what BAM should be obliged to do is report the consequence of any mismatch to you. So we need to attribute P&L to the managers out of benchmark bets, and we need to attribute P&L to this benchmark mismatch, which you need to be aware of, and you need to understand or be apprised of the consequences of it.
So just to supplement there, Antonio, from a policy perspective, as we've gone through the various asset classes, we have made an effort to try to rationalize the roll-up of the benchmark risk. So when there's a difference between the roll-up of the benchmarks of the managers and the policy benchmark, we need to have good reasons that they're different. So for instance, you all heard the high yield search recently. We had all kinds of different benchmarks. We didn't have any good reasons for that, and so we got rid of that and have a standard benchmark which rolls up perfectly now. And so each time we go through an asset class, we re-ask that question.
I mean, what
And
Scott's
now,
raising,
and now we're, to Miles's point, we're able to measure the consequences of, so if we do decide not to have them roll up, we can measure how much that's impacting the portfolio. And particularly when we get the performance attribution stuff from MSCI, we'll really be able to do a deep dive. Right now, we can just go down to asset allocation versus selection, but there's all kinds of stuff, as Miles pointed out, in both statistics that you really want to get underneath to really understand what's going on.
kind of a major theme that we want to bring up is, there's certain things that managers are responsible for, and certain things BAM is responsible for, right? So if there's any kind of tilt, if any kind of adjustment to the portfolio, these things have consequences. If there's a benchmark mismatch, so we kind of need to attribute P&L to the consequence of decisions BAM has made and report on them to you also. And that's something we hope to bring out when we get to this P&L attribution portion of the implementation.
Other questions for, or do you want to ask another one? Well, well, let me see if there's someone outside of MOPI who wants to ask a question before Antonio and I start dueling.
Antonio, what's your question?
Go ahead, ask another one.
So in regard to the active risk, just from I think we kind of intuitively knew what, certainly what the division of risk was between equity and fixed income, and generally that we have more active management in fixed income than in equities. But were there do you feel any kind of surprises as you went through this exercise as far as like where we're spending our active risk? Are there places that maybe we would like to change that? I mean, I know that's a little too forward-looking, but were there any kind of surprises around where we're currently spending where our tracking error is coming from, and things that we might want to change about that?
Yeah, I think we need to spend more time with the reports to understand, the value of active management's creating versus just a purely indexed strategy. I don't have a preconceived. I'm not sure we get into that today, but a sort of general point to make that may be responsive is just it should, as you probably understand, active management is more part of the fixed income world. It's possible to index an equity portfolio relatively easily. It's much more difficult to index a fixed income portfolio. So in that sense, I wasn't surprised. I didn't know the magnitude of the kind of difference, but that we should see more active risk in the fixed income side was expected.
Okay, I'm still looking around the room. All right, I'm going to call on myself. So, Miles, you talked about how the asset class teams will be able to use the tool to essentially underwrite risk, both as they're looking at prospective managers and also with our existing managers. Will those, and I don't know if this is for you, Miles, or for Scott, will that underwriting become part of both the reports that we get for the underwriting reports we get for prospective managers, as well as the performance reporting that we start getting on a regular basis?
Yeah, I would certainly expect, John, that the information contained in the risk reports would work their way into our analysis of the managers and would be part and parcel of our explanations, both of what we expect the manager to do and then what the manager has done. Mm-hmm. The level of detail in these reports is exhaustive, and so I think that the right thing to do is, on a regular basis, to stay at a fairly high altitude to look at the portfolio dynamics with the board, and then when we're talking about specific managers, we will have the information to talk about the attributes for that manager that are part of the roll-up process. So it'll work in even indirectly. And if you have a situation where the risk footings from MSCI are a critical point in question, we would of course provide that information as part of our discussion.
Yeah, one of the sort of an example that comes to mind is when you brought the global managers to us a few months ago, and asserted that this is a way to get active exposure particularly in the U.S. equity markets that we are typically not looking for because we're mostly passive in U.S. equity markets. And that was an assertion, but with no data behind it, really. So I would hope that this kind of analysis would allow us to actually assess that assertion.
Yeah, right now we're dependent on the manager's analysis, consultant analysis, which is not always on a consistent and comparable basis across our different managers. We'll now have the facility with the MSCI tool to make a consistent analysis, which is quite comparable.
So just to just kind of repeat, these are the somewhat automated reports. These are going to be produced on the monthly cycle. There is this capability to do ad hoc analysis, and I think you're going to start seeing examples of that inserted in the investment memos that you get in the quarterly, in the periodic review of the asset class. But this is we need all of BAM to embrace this and start using it, and getting that sort of adoption is going to be isn't going to happen overnight. But yes, I think you'll see lots of examples of the ad hoc analysis introduced in our underwriting.
Yeah, we're still in the let's make sure the data is right phase. Yeah.
I just two more points. The first is, so when we did the asset allocation review 2 years ago, one of the concepts we discussed was risk budgeting, right, which many pension funds utilize and which we don't. And so both in terms of looking at our overall asset allocation and then looking at the individual manager recommendations, do you anticipate being able to sort of say, okay, this is the effect this would have? So you showed that our risk right now is 6.66, if I'm remembering correctly. Right. That's quite the diabolical number.
I don't know how we came up with that, but yes, that's the...
But so, for example, to say, okay, this... If we go with this manager, you know what I'm about to say.
So
go ahead,
John, I just want to. We don't yet have a thought as to how we should overhaul or whether we should overhaul the actual asset allocation process. I mean, should there be an allocation to factors rather than asset classes? Well, that's a big, broad question. But you're going to start to see a kind of an example of how risk budgeting could work when we talk to you about FX. Because what we're going to say is that the hedging of the volatility introduced by FX could be is essentially risk appetite that could be redeployed into an asset class that has an expected return. So that is an example of kind of a risk budgeting type of analysis. But we're not yet ready to prescribe a
overall risk
framework for
it.
But you're absolutely right, John, that the MSCI tool gives us the capability of doing a risk budget if we wanted to.
Yeah. And in some ways, I think what I'd be interested in is not necessarily making a wholesale switch, tomorrow, but doing parallel analysis so we can see, okay, what effect might this have on our overall risk, and before we get into wholesale risk budgeting.
Yeah, in other words, you can start reporting on how is your risk being taken up today before you start having standards for what it should be.
Right.
Totally agree.
Okay. So just the last point I want to make is I really want to commend you, Miles, and Bam and Scott for getting us here. I think Scott knows that when I got here, which was about 3 years ago, I asked, for, okay, where's the risk reporting? And because, I feel like as trustees, we need to know this information. It's actually, I think as a trustee, it's a requirement that we know what risk we're taking and what the risks are to our portfolio. And I know it's been a long road, and I just want to really commend you for getting us.
I want to speak to that just for a second. I really appreciate that. And I just want to say, the implementation of this thing is a massive undertaking, and we've, the two members of the risk team are here. There's a number of them over there. It's a big project. It's taken longer than I expected. There have been, procurement, various pitfalls along the way, but it is happening. It's just it's taking a couple months longer. It's great that it's happening. A couple months longer than we had hoped, but we're getting there.
I really appreciate it. I think all of us, even if we are not completely, if we're not completely understanding 100% of what this means, I think it should give us comfort that the BAM team is getting us to this point and taking us further down the road to having an understanding of what the risks are, so that it's not just performance reporting in a vacuum, but that it's really risk-adjusted performance, which is really what we're after. Because, especially during this time of bull markets, virtually every asset class across the spectrum, of course our performance has been good, but you really want to know what risk you're taking in order to achieve that performance.
So the two things I wanted you guys to take away from this are one, not that my phone's ringing, that the implementation is underway, and the second is that I want to reiterate the invitation. We at any point, if a sort of a more involved teach-in, absolutely, we'd love to spend as much time with any of you as you'd like to understand these.
Don't go yet, because let me see if there's any other questions or comments folks want to make. Are you good? Okay. Okay. So is that it for the
That's
listening? Okay. Great. Thank you, Miles.
Thanks, Miles. Mike Haddad is going to start off. We're going to talk about asset allocation, but in order to do that, and we were giving a presentation that we basically had for last month's meeting, but as you remember, the weather was so terrible, we decided not to give that presentation. You all had the slides. Mike and I are going to go through pretty much the same slides today, giving an update on where the market's right now, what are the implications for our asset allocation, and at the end I'll talk a little bit about our work with the consultants on evaluating a strategic allocation update. So turn over to Mike. Yeah, so you should have it in both the March and the April. The one that you have in April is Mike's slides are a little updated, just a couple more data points.
Good morning.
If people are having a hard time finding it and convene, just let us know, and we can come around and help.
And just before I launch into current market conditions and challenges facing markets, just want to tie in what Miles was talking about. And he started with that we saw he showed you a small portion of what we can do with that risk system. And it's going to be extraordinarily helpful to us to think about the portfolio on a forward basis, via those stress tests, understanding the risks in our portfolio. And in the past, when we've done asset allocation, there's three variables that we take into account. That's expected return, expected risk, and expected correlations. Now we're going to have the actual portfolio to do this with. So he was understated in the many, many different applications that we can use with this. And I just want to say thanks to you all again for advocating the risk system for us. So that being said, I'm going to talk about current markets, the challenges that we face, and some global macro issues. So the first slide, which is going to tie into the current valuations that we face, is a reminder of the extraordinary returns we've had in public markets since this slide is dated March 9th, 2009. There's a little bit of cherry picking going on here in full disclosure. That was the dead-ass low in markets. So the returns look extraordinary, but even if you adjust it by a quarter or two, that's a technical term. So you can see U.S. equities over the last 9 years have returned on average 19.4%. And you can see the various returns on those. And as a reminder to how extraordinary these are, most consultants would use U.S. equity average return on a 10-year horizon, 6 to 7%, EM equities more like 7 to 8, and EFI equities more like 7 to 8. So these returns are well in excess of what standard returns in equity markets have been, which kind of sets us up to where we sit today. So issues facing the markets. You've heard me go on at length about global QE. I'm not going to let it go. Like a dog with a bone with this one. We're in the process of being $1 trillion less in 2018 than we were in 2017. That process is underway. By the end of the quarter, that QE nomenclature is going to turn into QT for quantitative tightening. So there's still net adding on a global scale, but by the fourth quarter of this year, that's going to be a net reduction in quantitative easing in markets. These next three bullets, I'm going to have slides to talk about, so let me just go through them individually. So interest rate increases are going on globally. It's not just the U.S. Canada and UK have also been raising rates. And I really want to focus on U.S. because it's the bulk of your portfolio and the benchmark against everything that's measured against. So 3 lines on this graph. The yellow line is what markets have built into rate increases in forward markets, and on the x-axis down below, the years 27, 18, 19. Those are the end of those years, just so we kind of orient what's going on in this slide. So what the yellow line tells you, by the end of 2018, the market expects 2 more rate increases. The blue line is what the Fed's projections are, and they release new projections once a quarter on the March, June, Sep, D cycle. So these are updated as of March 21st, and the Fed expects 2 rate increases as well as the market does. But if you go out to the end of 19, the Fed's expecting an additional 2 more, while the markets are only priced for 1 more. The red line that I put in there is a hypothetical line, and that's assuming a total of 4 rate increases in 18 and 4 more in 19. And this is consistent with what JP Morgan is forecasting, what Goldman Sachs is forecasting, and in my own humble opinion is a more reasonable forecast. And the point of showing this to you is the interest rate markets are not priced for what is likely to happen in terms of rate increases by the central bank. So if the red line is actualized versus what the yellow line is, we have more rate increases in market rates to go forward, and all the implications that come from that.
Can I interrupt you asking one question?
Of course.
So Donald Trump tweeted, Russia and China are playing the currency devaluation game as the U.S. keeps raising interest rates. Not acceptable. So I'm curious as to whether or not you feel that has an impact on the Fed's future plans to increase interest rates, or is it just a miscellaneous Trump tweet?
One of my mentors years ago taught me the following statement.
Don't pay attention to tweets.
Watch what someone does, not what they say. And I think in all of our lives we can say that, and I would echo that. That being said, we have a tremendous trade deficit, $500 billion, the bulk of it's with China. The currency differentiation, I would argue, is a small part of that trade deficit. It really gets into the cost of labor. You know, our cost of labor is, I don't know what the multitude is, 30 times higher than the cost of China's, and so it makes it less expensive to produce goods in China rather than U.S. And we're not going to drop our wage standards to China's, and nor are they going to raise them to ours. So we're stuck in this kind of place where this trade deficit exists. If you really drill down into that tweet, why waste our time? He's arguing that they are having their currencies weaker than they would otherwise if they had an open market. There's some legitimacy in my mind with China. That goes back historically. In '94, China joined the WTO, and that allowed them to trade with the world. From that point for the next maybe 12 years, they kept their currency cheaper than it would be otherwise. Their currency doesn't float in the open market. But over the past 3 or 4 years, China has allowed their currency to appreciate versus the dollar, not depreciate.
I was more curious on his reference to the interest rates and whether or not there was a difference in opinion of the Fed and maybe. I don't know if he has any policy advisors or if from the president's office.
Theory would argue a weaker dollar is more stimulative for the U.S. economy. It increases our imports and it raises cost of goods that we import. So if those currencies are weaker than they would be otherwise. That makes our dollar stronger, and that would be slower economic growth. So you think about, remember from your economics textbook years ago, GDP equals consumption plus investment plus government plus net export. So it falls into the net exports component. On the margin, it matters. I would dismiss that from the source. The other thing I wanted to talk about in current markets is the fiscal stimulus that's been put into the economy through two sources: the tax cut in December, and then the budget that we got in January, which resulted in an increase in the spending caps that had been in place in the budget for quite a while. And they're meaningful numbers, and they dramatically impact not only our deficits, but as well as markets and just general economics. So the first slide shows you the I guess pink magenta bars on the right side is the CBO's most recent scoring of the two different pieces of fiscal stimulus, and as you can see, those bars are well in excess of the 50-year average or the 30-year average, whatever that is up there, and they're in the 4 to 6% over the next 10 years. And if you just look at this chart for what it's worth, you're like, okay, it's kind of, it's not as bad as it was in 08 through 12. But remember the math on this. This is deficit divided by GDP. GDP in those years post-crisis was declining, or it was negative or barely growing. So the numerator, in fact, is what caused that number to go up so much. These numbers are problematic from the standpoint of a budget deficit. So the question is, do budget deficits matter? Do they not matter? We'll get to that in a second. And I want to decompose those numbers one more time. So if I take your eyes to the right side of the graph, post the current time, the dark blue bar is where the baseline budget was prior to these fiscal stimuluses. That teal color is the darker, whatever that middle color is the increase in the deficit from the tax cuts. And as a reminder, it was about $1.5 trillion of stimulus, that the bulk of it came into a drop in the corporate tax rate from 35 to 21, and it was all funded in the out years through deficits. And the second, that other lighter color line, is the increase in the deficit from the spending caps. Now to think about fiscal stimulus and the increase in the deficit, there's a good side to it and there's a bad side to it. The good side is realized up front. When we drop the corporate tax rate, earnings in 2018 shot up almost $10 a share if you just look at the S&P 500. So positive for earnings, positive for growth in the short term. In the long term, we got to pay for this, and that comes through increased government issuance, more debt we have to raise, as well as a declining impact on the economy of the positive effects of the budget deficit. So while this is near-term positive, and it's been positive for the equity market, and it's been positive for growth, there's longer-term consequences to deal with it. And then the second part of the negative part, I want to get into it, and the punchline of it, and then I'll explain it, is that this is likely to result in more inflation and then more Fed rate hikes than we would have had otherwise without the stimulus. So what this slide attempts to show is the unprecedented timing of this fiscal stimulus, meaning that the economy is running at or near full capacity, and to add growth into an economy that's already running hot is going to result in higher inflation. So the blue line is the unemployment rate, and the scale is on the left-hand side of the chart, and it's inverted. So the higher that number goes, the lower the unemployment rate, which, said differently, is stronger the economy. The red line is the budget deficit, and its scale is on the right-hand side. The lower that number goes, the greater the budget deficit is, as measured as percent of GDP. And so what's unprecedented about this is the markets have never gotten this amount of fiscal stimulus when the economy has been running this hot, with the exception of the two points on the graph there, and that was in periods of war. And there's an obvious reason for that. One could argue we're at war, but I think it's a terminology issue. But the point is, in those two periods, what was the result of that? The result was higher inflation, and we had to pay for it with higher interest rates in the out years following that. And outside of recessions, we don't add fiscal stimulus. So we're getting fiscal stimulus when the economy is running at or near full capacity, and this is going to result also in higher interest rates. So those are kind of the issues that we're facing, and I have a few slides to talk about valuations, which kind of is going to tie into Scott's point of our current asset allocation. there's a lot going on in this slide, so let me try and explain it to the best of my ability. So this is equity valuations using a valuation model with those 5 inputs on the right side of the slide. Those inputs are all traditional type of valuation metrics one uses in equity market. This model goes back 70 years, so there's a lot of history to this. Within the graph on the slide, it divides the valuations into 10 different deciles, with the right-hand side being the most expensive deciles and the left-hand side being the less expensive. What the blue bar represents is the average returns in the following 5 years when the equity market has been in that decile. And what you take away from that is, again, based on this model, over the next 5 years, we should expect a 0.3 positive return on an annual basis in the equity market if this valuation holds up. And you can see in comparison, if we're in the first decile, the less expensive decile, one would expect significantly higher returns in the equity market. Second takeaway is the red dot, and what that red dot signifies is the number of years of, on a percentage basis, of positive returns over those forthcoming 5 years. And you can see in this decile, when the equity market is so expensive, this model would suggest only a 35% probability of having positive equity returns each year over the next 5 years. And again, in comparison to what you see on the opposite side of valuations, you would expect almost 100% positive equity returns each and every year if we were in that decile. And the other thing I would say on this is, if you again look at the valuation inputs, most of them, every one of them has to do with price. So if the equity market was to correct 10, 20, 30% for whatever reason, that model's going to shift. And that's the thing that drives the model more than anything is the price in equity markets. The fundamentals in the equity market are fantastic. Prices are high. This slide draws upon the 4th input in that model, and that's, you can call it the CAPE ratio, the cyclically adjusted PE ratio, but it's a 10-year look at backward PEs divided by inflation. And so what we're trying to show in this graph is that the U.S. market, the blue line, is well above its 13-year average. The EFI market is slightly above, while the EM market is slightly below. And in additional context on that, the U.S. market is at a very expensive valuation metric, as well as we're in a rising rate environment. Where the European market is kind of right on its more average over the past several years, and the interest rate market is a good 2 to 3, 4 years lagging behind where the Fed is right now. And interest rates matter, but what matters there is more the EM currencies versus the dollar. So if the dollar's declining or the dollar's rising, it's going to drive what EM central banks do more than anything. And the dollar is down almost 13% since its peak in 2017. So I would argue the dollar is in kind of one of these bear phases, which would argue that the headwinds for EM are more tailwinds in terms of monetary policy. This slide is credit valuations. The blue line is the high yield valuations. Take that over to the left-hand scale. So we're kind of in the 400 basis points kind of over treasuries. The gold line is investment grade spreads, and that's on the right-hand scale. Takeaway from this slide is we are at or near all-time spread tightness, richness of valuation metrics. So both high yield and investment grade are rich relative to where they've been over the past 18 years. And my last slide on valuations is the mortgage-backed securities. The yellow line, the nomenclature there is option-adjusted spread. That's what OAS stands for. That is how fixed income folks value mortgages relative to treasuries. And you can see that black dot is where we currently are. And compare that to the 3 horizontal lines in there. The green line is the post-2009 average, so a slightly wider spread versus 2009. But as a reminder, 2009 is when the Fed kicked off their very, very extraordinary monetary policy easing, both zero interest rates as well as quantitative easing, in which they bought mortgages. The blue line is the long-term average, which incorporates both pre and post the financial crisis. And Interestingly, the purple line on top is the average if you exclude the time period when the Fed was buying mortgages. So the takeaway from this slide is we're fairish in valuation if you exclude the time when the Fed wasn't buying mortgages, and I would argue that's appropriate because the Fed has stopped buying mortgages. In fact, they're letting mortgages run off their balance sheet, and the environment should be more akin to looking at that purple line rather than the other line. So let me pause there before I turn it over to Scott to talk about your specific portfolios.
Questions for Mike? Antonio.
I was wondering if you could talk about the yield curve and particularly the flattening. I mean, I think the difference between the 2 and the 10 year right now is 40 basis points. The difference between the 10 and 30 is like 20 basis points. And in particular, in the context of like the growing budget deficits and thinking about having to have more rate hikes to kind of cool off the inflation and kind of the hot market.
Is your question, is the yield curve a predictor of a recession?
Yes.
Historically, the answer has been yes. I would argue in this instance, no, for a few different reasons. The front end, again, these are old trading rules from my past life. The front end is local. The long end is international. What do I mean by that? The front end is more dominated by monetary policy in the U.S. So the Fed's on a rate raising cycle, more to come. The 2-year note yields whatever it yields now, I don't even know where it is, 230 today, 240. So it's anticipating the rate hikes. The back end is driven more by domestic as well as global in situations. You know, the Bank of Japan is still in their quantitative easing. They've moved away from a quantitative to a target. They're targeting their 10-year note at 0 basis points, plus or minus. So you think from a Japanese investor standpoint, you can buy JGBs at 0, or you can buy U.S. 10-year notes at 280. You know, there's currency risk involved in that, but there's a lot of inflows from Asian investors to buy our government bonds. Same thing in Europe. They're still engaged in quantitative easing, though it's much less. You know, Bund yields, what's the 30-year? It may be 70 basis points in Germany. So the discrepancy on international rates drives foreign investors to buy our long end. And I think that more than anything is holding down our long end. And I think our long end is, you know, if you will, mispriced relative to the fundamentals in the country, but with a good understanding as to why. Another way to think about, so yield curves typically predict recessions, and I'm arguing that it's not. So another way to think about the local part, the front end, is the Fed becoming restrictive in monetary policy. A way to measure that is the real funds rate. So inflation is basically at 2% now. The funds rate is at 1.625. It's a negative funds rate. It is historically extraordinarily stimulative. Restrictive levels of funds rate, as measured by the real funds rate, are in excess of 2%. So if we get the funds rate to 2% over the inflation rate, so something like 4 to 5, I think it's a more valid argument. So I don't think, on that measurement, monetary policy is not restrictive. Third argument I would give you is financial conditions. As a reminder, it's the equity market, the bond market, spreads, and the dollar. It's at or near its all-time easy point, meaning conditions in financial markets are stimulative for growth based upon those 4 metrics. If the yield curve recession, if the yield curve was predicting a recession, financial conditions would be very, very different. So I kind of think the long end is mispriced and is being held in by foreign buying, and that therefore makes the predictor of recession not valid in this environment.
Any other questions for Mike? Thanks, Mike.
Thanks, Mike. I always marvel when I listen to Mike talk about the macro economy, and I'm so thankful that he's here working on our team. He's brought a dimension that we didn't have at BAM, and is actually quite rare. For a pension fund, we're a big oil tanker. We're on a long voyage. We point that sucker northeast, and we're headed to the destination. And it doesn't pay us to fool with the settings much. And so we don't always need the expertise of a guy like Mike Haddad. We don't always need to be thinking deeply about these things because we're 65-35, got our strategic asset allocation, good to go, foul weather, good weather, it kind of doesn't matter. Unless it becomes very obvious in a very calm period of time that the possibility of very bad storms are afoot. And we are in one of those times. And so when I came in here as your CIO, I said most of the time we're going to have a target asset allocation. We're going to stay very close to that target asset allocation. We're not going to fool with it much. If we really have a good reason to tilt it, we'll tilt it within the rebalancing range that you give us, and we'll talk about it when we start to make a meaningful tilt. Not the regular rebalancing stuff, but meaningful. Last month, we had the same presentation to talk about it with you, and we're here to talk again because we're not in Kansas anymore in terms of this market. This government is behaving in an aggressive, irresponsible way from an economic standpoint. When you look at their fiscal policy, forcing the Federal Reserve to become more aggressive, risking inflation, and risking an interest rate rise, which will hurt all of our risk assets. And we depend on these risk assets to provide income for our beneficiaries over the long term. Now, we could just sit here and say, look, we're long-term investors, we'll weather the storm. But when we have the capacity to analyze it, and the readings are this extreme, I mean, just go back to this, I'm going to use some of Mike's slides. Look at this slide. It is absolutely captures everything. You know, we're expecting 7% return for the whole portfolio. Most of that we're going to get from equities or equity proxies like private equities or high yield or so forth. And you can see in most environments you get 7% or more. You know, if valuations are really low, historically you've gotten more than 7%. And really the only time that you're going to be in the type of weather that you would worry that you're not going to get a 7% return is when valuations get up to the 9th or 10th decile. They're way in the top of the 10th decile, and Mike made the same point about high-yield bonds, about investment-grade bonds. We are not getting paid to take risk almost anywhere, and so we are, you know, steady as she goes, folks. But even we need to make some adjustments now. And so let me talk a little bit about the adjustments we're beginning to make in the portfolio. This is the normal slide that you see. These are our growth assets. These are our risk assets. This is where we make the return over time for our participants. And flat, as you all know, where the bubble is on the zero means we're right at the target asset allocation. The big bubbles on the left are, of course, the U.S. equities. The most overvalued geography in the most overvalued part of the world, where the calmest waters. Earnings are great. Companies are increasing dividends. They're giving workers bonuses. It's a very positive environment, but it's not sustainable, as Mike articulated. We're going to let the U.S. equity weightings go below target up to the rebalancing range before we would come back to you formally if we think we need to go below the rebalancing range. At the end of the year, we were more or less right on the zero target. In order to offset this, as Mike pointed out, the valuations in emerging markets and in EFI, or the non-U.S. developed markets, are reasonable on a total basis and certainly attractive relative to the U.S. So we're going to let those weightings go up a little bit. We're confined by the basket clause, as you know. We were already up a little bit above the benchmark or the target at year end, and we expect to flirt with the top end of that if we can do it with the basket clause. The other place, and we've talked a lot about it, Where we're going to allow the weightings to go underweight is in high yield, and as we've since the end of the year, we've done the high yield search. We talked a lot about the fact that we're not going to deploy the full amount into high yield, and so you'll see that that amount decrease as well. The other places, private equity, OFI, et cetera, those are really long-term investments. The money we're committing is not going to be deployed for a couple of years. It really doesn't make sense to tinker with the timing or the weighting there. It's kind of not productive to do so. One area that we can, and this only pertains to police and fire, let the weight increases in hedge funds, because the risks that are being taken by hedge funds for the most part are uncorrelated with many of the risks that we've been talking about. Some of our macro investors do actually take bets one way or the other on these macro factors, but generally speaking, hedge funds returns will not be heavily correlated with this, so we think that we can let the hedge fund weight run higher. We will not let any of the weights run beyond the prescribed rebalancing ranges without talking to you first. So if we start to approach the edge, we think we're going to go past the edge, we'll come and talk to you. We may, pierce the edge briefly if you have a sudden movement in the market. But we need to let you know that as you look at these bubble charts from quarter to quarter, they're not going to look normal until the markets return. They don't have to return all the way to median levels, but they have to get back to kind of a rational place. On the fixed income side, we are, first I'll start with inflation-protected assets. We think that the place that we're most likely to let things run higher is in bank loans. Bank loans have, they're very solid in terms of the credit risk, and the interest rates are variable. In other words, they'll move up as interest rates move up, so they won't be as hurt as nominal bonds. We think this is an area in inflation-friendly that we can allow things to run higher. We will, continue to deploy money in real estate and infrastructure as quickly as we find good opportunities. These asset classes will hold up well in an inflationary environment. And TIPS are a complicated beast. We can talk about those offline, but we're comfortable with the TIPS weightings that we have. On the deflation protection, it's one of the places that money is just going to flow is into treasuries, right? Mike spoke about mortgages. He spoke about investment-grade credit, not getting paid to take those credit risks. We're already at the bottom of the range in mortgages. We're going to let the investment grade move towards the bottom of the range as well, and all that money's going into treasuries. So we're going to have a lot of treasuries. But treasuries are not going to be equally impacted here. Short-term treasuries won't be that affected because their sensitivity to interest rates is not high. But those long-term treasuries, the ones that we want for insurance for the long term, those are going to have a very difficult time in a rising rate environment. So we are unlikely to buy a lot more of those until rates, or certainly rate expectations, get back to the place where we're expecting. So you'll see the duration on the Treasury portfolio move back a little bit, and I'm going to show you where we are today. You can see the ultimate goal and where we are today. Take teachers' ultimate goal with the Treasury portfolio is 17.4 years. We're at 12.8. We're just looking at Treasuries now. Expect that actual number to slip back a little bit and create a increased target. Not that we're selling long term, but as we have more short and intermediate term Treasuries in the mix. A better way to look at the overall effect, we think, is to look at the rate sensitivity towards the entire portfolio. So you include both the money that's coming out of equities and the money that's coming into fixed income. And so we'll introduce another statistic. It's a basic statistic in fixed income. It's the dollar sensitivity of a 1 basis point change in interest rates. And you have it here. And this is just a different way of expressing the sensitivity of the portfolio to changes in rates. And we would expect that we would continue to make progress towards our goal here. And how can that be? Because when you take money out of equities and put them into fixed income, any kind of fixed income, you increase your rate sensitivity. So as money comes out of U.S. equities, for instance, it goes into short-term treasuries, that's actually going to increase our rate sensitivity, because as we calculate equities, they have a 0 duration, and the short-term treasuries have some duration, although it's less. Since we came, these are modest movements in the portfolio. If we go all the way to the edge, we'll be underweight equities by 5%. I was at a conference recently of major pension funds, and I saw a pension fund, very excellent fund. I'm not sure that the data is public, so I won't identify the fund, but very strong track record, very well regarded. They're 35% cash, which is an extraordinary tilt for an equity, for a pension fund. I'm not talking about that. I'm talking about going to the edges of our rebalancing. Not immediately, depending on the environment, but you can expect us to use the rebalancing target. Okay, what's this all have to do with our strategic asset allocation update? We have, since we last talked, met with each of the consultants, general consultants. We have 5 of them, 1 for each system. And we've gone through an exercise of evaluating the current conditions, looking at things on sort of a 3 or 5 year basis, looking at things on a 10 to 30 year basis, which is the usual time frame for strategic asset allocation, and come up with the following sort of consensus feeling. Everybody agrees in principle with the direction that we're thinking of leaning the portfolio. Some consultants prefer one lean versus the other, but I think there's a general consensus, and you're welcome to speak with the consultants about this, that what we're doing is consistent with valuations in short to intermediate term environment. But when you look at the things on a 10 to 30 year basis, a lot of these misvaluations kind of wash out, and you don't come up with readings that are terribly different than the asset allocations that we currently have. We might have a slightly smaller high-yield allocation, a slightly higher allocation to bank loans, but it's not significantly different. And so the consensus feeling among the consultants in working with our staff was that we would get a lot of the benefit from doing these tilts, evaluate the situation as we go, but there was no crying need to update the strategic allocation because we're getting many of the same readings. That being said, this is your decision, and so if you all would like us to continue with the consultants to study, a typical formal revaluation or reevaluation of the strategic asset allocation, we'd be pleased to do so. It's just our feeling and the consultants' feeling that we'll come out with very similar results. With that, I'm happy to take any questions.
Questions for Scott? So I have a question.
Yes, sir.
If you could go back to the second to last slide, that one. So the first question is, we basically have 2 approaches to the treasuries, right? We have the longer term duration, the shorter term duration, and the difference is greater on the shorter term. Do you expect to reduce those like NYSERS and BRRRR's duration from what it is today as well, or just the longer term?
Yeah, the magnitude will be less, but what's happening when money comes into treasuries now? It's mostly coming into shorter-term treasuries, which would be below the duration target of all the systems. But the magnitude of the impact, the magnitude of the pullback of duration will be larger for teachers.
So what would the new target be? That's really my question. The previous target for the longer-term ones was 18. I think it was 12, if I'm not mistaken, for the...
So the target wouldn't change, right?
Well,
because
but you're planning to diminish the duration. So,
No,
my question is to what?
Yeah. So well, it depends. It depends on how long the situation persists, and how much money we put into short-term treasuries, and a lot of things. The modeling we've done so far would suggest it will come down, because we don't have any specific goal where we're going to go to.
That's really my question.
Yeah.
So shouldn't we have a specific
No,
goal?
we don't. What we've done is we've begun to move the portfolio in the directions that I talked about. I can tell you we won't go beyond the rebalancing limits, and we're constantly evaluating the situation.
So the rebalancing refers to the percentage of assets in the asset class. What are you expecting to be the downside limit on duration? I'm really asking about duration here, not the amount of assets.
I understand, and I don't have the figure in my head. I don't know, Mike, if you or your team do.
I would urge you in the second slide we showed.
Is your mic on? Sorry. No, it's worse. Sorry.
That's better. Okay. I would urge you to look at this slide, and this is the reason we introduced the dollar value of a basis point. This is another typical way that one would look at any kind of fixed income portfolio. And in the example that the real life example we're talking about, where we're going to be inclined to reduce equities and increase fixed income in short duration, the duration of your treasury portfolio is going to recede. Just the math is what it is. But the dollar value of a basis point of your portfolio is going to increase, because we're net adding duration to your treasury portfolio. So if you measure it as a DV01 instead of duration, we're actually increasing. So, again, there's many ways to skin the cat in looking at this, and we want to show you both ways of looking at it, because while you are 100% correct, we are shrinking the duration, we're increasing the DV01.
So what?
So just to
it sounds nebulous to me. So what I'm asking is, what are you shooting for?
Yeah.
Otherwise, how do you know how you're doing?
So, John, let me try it in a I'm going to say the same thing, but from a different angle. What are we doing when we're buying these treasury securities? Because they don't give you any return for risk. These are so-called risk-free securities.
I'm going to say we're getting 2% return now.
No, I understand.
Yeah, but it's not zero anymore. It's a
no,
big
I understand. So let me finish. And so the treasury securities are the one security that fairly reliably, not all the time, but fairly reliably, hold up well when the risk securities are going down. They provide a type of insurance.
I understand.
It's an analogy, not an identity. So what this measures is how much insurance do we have, right? So the top is our target for, how much will we have if we had the high-powered insurance of the long-term treasuries in the quantities that the systems have requested. And you can see that teachers has the highest would have the highest rate sensitivity or insurance in the portfolio if we met the target. As we put more money into these treasury securities, regardless of the duration of them, the actual number is going to go up. And so we're going to approach the ultimate insurance that we wanted. We're just buying a different type of insurance than we had forecasted. In normal times, normal weather, you want long-term insurance, you want long-term bonds, because they're very sensitive to changes in rates, and you only need to put a little bit of the portfolio in long-term bonds to have insurance. But if rates are going to go up, it's going to be very bad for that type of insurance. So you're better off buying the less efficient insurance of shorter-term bonds, which you have to take more of your portfolio to put in, but it'll hold up better as rates increase. So there's a.
So can you explain why this is a great deal of variability for the targets among the funds? And the variability, so I mean, it's interesting to me, for example, that NYSERS and police, which have very different duration targets, have virtually identical targets on this dollar value per basis point. Try to say that 5 times fast. Why?
Yeah, I would, I don't know that.
It's the size of the plan.
Yeah.
Yeah.
So DV01 incorporates the size.
This is in dollars.
The dollars.
It's in dollars.
It's duration times dollars.
But NYSERS and teachers are the same size, but they have different duration targets. I mean, so I'm not understanding, and please forgive me, and I beg everybody's forgiveness that I'm obviously not too advanced on this point. So if you could explain it to a lay person like me, that would be great.
NYSERS has a different duration target than a much shorter one than teachers. So therefore, their target's going to be lower.
But police has the same duration.
Has the high duration target, but has significantly less assets. So their DV01, dollar value of a basis point, is going to be lower.
They're using, if you use my insurance analogy, they need less, to put less at risk to get the same insurance. So even though they're a smaller plan, they're using more powerful insurance, and so that's why one of the reasons that you use the long-term treasuries. And so I would suggest that what we do is to come back the next time and go through this basis point impact on the value of the portfolio in some more depth.
Okay.
And we are, just because we've been wrestling with this ourselves, we've just gone to looking at this ourselves, although it's a basic calculation, but to try to focus on it with regard to the target, so that we can better reflect what's going on in the portfolio, because our weighted average of the Treasury portfolio is going to leave the wrong impression on what was happening in the portfolio.
And then, John, if I can also add, the duration extension plan is still in place. We laid out the plan for reaching our targets, and that's still in place, and happy to walk you through it again. But we got to 50% because we wanted to have a chunk of it in place despite our view that long rates were very unattractive. Is like, we got to get something started. So with the help of Rokutan, we put together a very robust model that helps us. And now we have a little more time to put the rest of it in place, knowing we already have half it in place. So that's still
But the
in
goal,
place.
so in other words, the original goal was to be at that target duration by June 30th. So now you're saying it's still in place, but obviously it's extended well beyond June 30th.
We haven't revised it yet, but our uncomfortableness has grown, and I would encourage everyone to speak with their trustee about it, their consultants about it. One of the key factors that drove this decision was the correlation between long duration and risk assets, and that correlation is negative in periods of extreme stress.
Right.
However, in periods of rising inflation, those correlations go positive, and that's one of the periods we're in, and that makes us less interested because that correlation shifts.
I would not, to Mike's point, I would not expect us to, if you just look at the Treasury portfolio and the duration versus target duration, I would not expect that to continue to close. I would, in fact, expect it to widen a bit. So it's a change from the plan, and I would expect it to even go back, below where we were, for the spread to be wider than it was, when we got to halfway. And it's the impact of all these changes happening at once. It's something we're very focused on, and we understand you want to be very focused on. So we'll continue to report on it on a detailed basis, and we're happy to have side conversations. I think you had a question
Dave
over here.
Kazansky.
So is there a sign or a number of signs that you're looking for that you'll move that original duration target back?
Yeah, we and I'll let Mike answer this in more detail, but he went through some of the, the basic gauges that we're using to show that how off things are. So when you get back to a more modest valuation in equities, particularly in U.S. equities, when spreads get to a more typical place for high yield and investment grade. In other words, you're getting paid what you normally get paid to take risk, or even maybe not all the way back to mean, but sort of just back to reasonable area, then we would take this bet off, because we don't. This is really a defensive move on our part. This is not us, trying to squeeze out extra money from the markets. This is us realizing that the markets are in a very unusual condition, and feeling that it's responsible for us to use the room that we've given ourselves to move to the outside of our allocation ranges.
And Dave, to be more specific, the model that Rokutan put together for us has, I can't remember, it's 5 or 6 factors that go into it. The 2 primary ones are the yield on the 30-year and the 5/30 slope. And to Antonio's question, the curve has flattened a lot. So the 30-year is almost unchanged. It sits right around 3%. And so the curve has flattened dramatically for the things that I talked about. So those 2 components are flashing red, as in unattractive.
Yeah, so when you get paid to take that 30-year risk relative to the 5-year risk, we'll be back interested in resuming the move towards the longer-term insurance.
Antonio?
I think certainly the fixed income component is the most important, given its size and kind of the complexion of our portfolio. But in addition, in the high yield and kind of international equity portions, as we feel that we can go towards the top end of the range, are there particular tilts that you think might be necessary within those components? That we have managers in, for instance, high yield that are more aggressive and more defensive. Right. We have managers in international equity that are growth or value. Are we agnostic around those?
So far, by the way, I would point out that we're going below in high yield, above in the others. But we have not started to tilt the sub-strategies. We have had discussions, active, vigorous discussions. Our rule is, we kiddingly call it the Merceburg rule, after our equity manager, John Merceburg, because unless there's a strong consensus that we need to move from our basic long-term plan, we don't. And so that's one where there's a lot of debate, particularly in equities, about should we tilt. Growth has outperformed value to an extraordinary extent, a very unusual extent. And so there's a big debate whether that's an extreme enough change. And we have people on both sides of the argument within BAM, so we're still debating. So, okay. Question?
Dave Kazansky.
So with the equity market so overvalued, is there any fears or concerns you have about reducing our position in long bonds?
No, I'm not talking about reducing our position in long bonds. I'm talking about not buying the full complement of long bonds as quickly as we thought, because there'd be a big negative reaction in the price of those long bonds when interest rates go up, as we expect them to do. So we're hanging on to the ones that we have, but the new Treasury bonds that we're going to be buying, if we sell equities, for instance, will be shorter-term Treasuries. So that's going to mess with the mix, and so that's what we're talking to, is the mix. So the amount of long-term bonds is sort of holding steady. We're adding shorter-term bonds. That's reducing the overall duration. Questions?
Other questions?
We won't go into this kind of detail all the time, but when we have something that's as big as this, we want to make sure we're being transparent.
Scott, I want to suggest, this is obviously a huge topic, and I want to suggest that we schedule times with each of the boards to have a discussion about the specific plans in those boards, at least the 4 boards on which I sit as a trustee. as opposed to, this is a good discussion, but it's pretty high level and it's kind of broad.
Right.
So I would like each board to schedule times, not today, so that all the trustees can participate at the 4 boards
Sure.
in the future.
Sure.
Okay.
And again, all these movements we're talking about are within the ranges, rebalancing ranges that we have. We would need your formal approval before we widen the rebalancing ranges, and would certainly be back here to do so. But we're happy to have any conversations you'd like to have.
Yeah.
And just to, sort of follow up on what John said, I think from my perspective, the conversation at the individual boards is less about these tactical shifts that are happening and more about, sort of what the consensus is for going forward.
Going forward with the strategic plan, yeah. Oh, I'm sorry, I misunderstood
what I
you,
meant.
John.
Yeah.
So absolutely
Yeah,
happy
because
to
we
do
want
that.
have our, I think we want to have our consultants involved in that discussion.
I'm sorry, I thought you were talking about the tactical stuff.
Yeah.
Yeah, absolutely on whether we do a strategic, and it's appropriate to do it in the
Right,
separate
so
boards.
I think each board can discuss whether
Yeah.
we do that on the side at a SIM or at
Right.
a regular board meeting, or however each board wants to address it. But I definitely want to have those discussions with each consultant as well as with BAM
Right.
about the broader strategic allocation.
Good.
Okay. Mr. Santander.
Thank you. Scott, how long does it take to turn the aircraft carrier, so to speak, on reducing this allocation, going more into the treasuries?
Yeah, Ray, you want to turn a big vehicle slowly, and you might technically be able to turn it faster than we do, but we're gonna make a gradual, consistent movements. We're gonna think a lot about it when we do. I give you a sense of the direction that we're likely to turn. We're also in public session, so it'd be inappropriate to be too specific. But this is our hedge fund managers drive speedboats. They see a wave coming, they head back to shore, and they get the thing up and out of the water. Right? We don't have that luxury, and so we'll make slight turns. Everything I've talked about, even going all the way to the edge of the rebalancing range, is a very modest movement. It will not protect us from a down market. We will lose money in the market, but we'll lose a little less money than we would lose if we didn't take some of these moves. And if the markets continue to go on and reach untold sites, spreads to go to almost nothing, which they're on their way to now, we'll make less than we would have if we'd stayed fully allocated.
Other questions or comments? Thank you,
Okay,
Scott.
thank you.
So before we take motions to go into executive session, I just want to acknowledge for the record several trustees that have come in since we did roll call. Andrew?
Andrew Gennardis, Brooklyn Borough President's Office.
Anybody else over in this side of the room? And Roy?
Roy Richter, CEA.
Thank you.
Pension.
Any other trustees who've come in since we did roll call? Great. Okay, yeah. Oh, okay. Well, while we're still in public session, I have been informed that today is a very special day, the birthday of Mr. John Dorsa. So let's have some applause. I will spare the trustees the pain of singing happy birthday, but
14 years from retirement, thank you.
okay. I'm not sure what that means, but anyway, we'll do the actuarial calculations. We have the chief actuary here. Who? John? Oh, Sherry's was? Oh, I'm also told that, boy, let's just do the whole birthday round here. I was also told that our chief actuary, Sherry Chan's birthday was yesterday. So happy birthday to Sherry. Is that correct? Do I have that right? Is my information correct?
If you take my birth month and square it, it's my birthday, so it's actually 2 days ago.
Oh, I don't know what that means, but okay.
Birth month?
That's
birth
way
month
too
is-
much.
That went
that's
right
way
over
too
my
much
head.
math for me.
Birth month is April, so it's the fourth month of
4.
the year.
I
You
get
square
it.
4, you get 16. That was 2
Incorrect
days ago.
information from the representative of the CEA here. Okay. Anybody else's birthday you want to volunteer here? Okay.
John,
all
I'm
right,
in
thank
July,
you.
but if you want to get it early, wish me happy birthday early, I'll be happy to take it.
Oh, we'll just take that under advisement for the month of July. Maybe we'll do a monthly birthday acknowledgement. Any other April birthdays here? Okay, nobody's admitting it. Okay, in any event, enough jollity. Time for motions to go into executive session. So let's do them in reverse order. Can we first have a motion from NYSERS to go into executive session?
So moved.
Thank you, Mr. Gennardis. Is there a second?
Second.
Thank you, Mr. Bonilla. Any discussion? All in favor of the motion to enter executive session at NYSERS, please say aye. Opposed, please say nay. Any abstentions? Okay, motion carries. Teachers, is there a motion to go into executive session?
So moved.
Thank you, Ms. Penny. Is there a second? I couldn't tell. Oh, Mr. Brown. Thank you, Mr. Brown. Any discussion? All in favor of the motion to enter executive session at teachers, please say aye. All opposed, please say nay. Any abstentions? Okay, motion carries. Police, is there a motion to go into executive session?
So moved.
Thank
Motion
you,
to go
Mr.
into
Dorsa. Is there a second? Was that Mr. Alejandro seconding Mr. Dorsa's motion? Thank you so much. Is there any discussion? All in favor of the motion to enter executive session at police, please say aye. All opposed, please say nay. Any abstentions? Motion carries. And fire, is there a motion to go into executive session?
Motion to go into executive session.
Thank you, Mr. McGinnis. Is there a second? Thank you, Mr. Kelly. You're too late, Mr. Dorsa, even if it is your birthday. Any discussion? All in favor of the motion at fire to go into executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Okay, we are now in executive session. Please turn the cameras off. I'm going to ask all members of the press and public, all the hundreds of you, to please exit. At this time, we're going to take a short break, and then we'll start with manager presentations in executive session. It's 10:57. Please be back by 11:10. Thank you. Please be back by 11:10. Thank you.
Cameras are on.
Cameras are on.
So I'll make a motion to enter public session of the Police Pension Fund.
Second.
Okay. So during the executive session, the trustees heard presentations and reviewed material from BAM, the consultants, and 2 firms. Action was taken, the results of which will be made public at an appropriate time. The trustees also heard presentations by BAM and our consultants regarding a review of 2 investment managers. No action taken.
So as there's
Motion
no...
to adjourn?
I'll second that.
All right.
Thank you.
Adjourn.
All right. Nice to meet you. Very good. Cameras off. Mike, you okay? Okay.
Go ahead.
During the public fire pension fund meeting, during the executive session, the board discussed various investment matters, reviewed personnel decisions, and also made decisions about which candidates to hire. We need a motion to adjourn.
So moved. Second.
Any discussion? Hearing none, the motion carries. The meeting is adjourned.
We're back in public session. Melanie, could you please report out of executive session?
The board to agree to invest in a small cap fund, the details of which will be disclosed at a later date, and the board agreed to invest in an income and growth fund, the details of which will be disclosed at a later date.
Yeah, let me just add that the small cap fund is private equity and the income and growth fund is real estate. Okay? All right, now we're also just going to have a brief continuation of the discussion that we have had earlier today in public session about rebalancing and asset allocation. And I'm going to recognize Mr. Schimmel to ask a question.
Yes, so we heard at the public session at the beginning of this meeting, discussion by the Controller's Office by BAM on potential over and underweights on certain asset classes. And I just wanted to hear from our consultants who have been right often on how we should do this, whether they concur, all the time actually, up to this point, thank you for the clarification, that they just give us just a reflection of your opinion as to whether or not it would be a prudent course. Obviously, there's more to be discussed, but if you could just have a 1 minute.
Sure.
If you concur or not.
So BAM asked us to do an exercise by looking at the current strategic asset allocation based on our expectations of the markets 2 years ago. And they asked us to use the updated 2018 projections and to project out what the expected returns and risks would be. So based on that, and of course the other consultants were also doing the same exercise for their plans, BAM came up with a consensus view, basically based on valuations and expectations going forward, based on the 2018 projections, where adjustments should be made. We had a back and forth about whether we were going to do a bigger strategic asset allocation review like we did 2 years ago, which would have been a bigger exercise and would have taken much longer. So we encourage BAM to work within the rebalancing ranges to utilize their views. And we are in agreement with where they are making the adjustments.
Thank you.
Okay, and I just want to say that we will have a more in-depth discussion about both the tactical rebalancing ideas that BAM presented this morning, as well as whether we want to have a broader discussion about the strategic asset allocation at a future meeting, hopefully in May. Okay? Any other questions or comments regarding the issue of tactical rebalancing and asset allocation? Very good. So I think that concludes our business for today. Motion to adjourn would be in order.
So moved.
Thank you, Andrew. Is there a second?
Second.
Thank you, David. Any discussion? All in favor of the motion to adjourn, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Meeting is adjourned. Thank you.
In executive session, we received a presentation on private equity investment. Consensus was reached, which will be announced at the appropriate time. We reached consensus on a real estate investment, and a discussion on securities in a certain industry was held.
Any other business before the board today? If not, I believe a motion to adjourn may be in order.
So moved.
Do we have a second?
Second.
All in favor?
Aye.
We are adjourned.